Hello and welcome to Learning Module 2 in Financial Statement Analysis. This is analyzing income statements. 5 LOSs to hit here, mostly describe or evaluate, but we will meet the king, in my opinion, of all ratios, EPS, earnings per share, later on, which we will have to calculate. So when we get there, there will be some calcs to do, but before that, it is a lot of describing. Let's hit our first learning outcome statement, which is describe general principles of revenue recognition, specific revenue recognition applications, and implications of revenue recognition, choices for financial analysis. So here we are, revenue. We're really saying here, what is it? And if you think about it, it's fairly important. It's one of the biggest, hopefully, numbers in the financial statements, right there at the top of the income statement. Yet, until 1999, there was no accounting standard that told you what revenue was. The idea was then, well, or before then, if I've sold something, I've earned revenue. It's a lot more complicated than that, as these standards should show you. Now, it's not examinable to know when the standard was written, but just bear that in mind. It makes all of this content a little bit more interesting when you realize, hang on, there's actually a lot to decide on before you can say, yep, there's some revenue that I should hit into the accounts. So here we go. What's the main rule? Revenue should be recognized when earned. Now, recognized means put into the accounts. If it's recognized, it goes in to your income statement. When earned, what does that mean? IFRS helps us out here. It is earned if the risks and rewards have been transferred to the consumer. So it could be goods, could be services. Let's just think of a really ridiculously simple example, one that even pre-1999 standards would have got right. I sell a t-shirt to somebody in a shop for cash. They give me the cash, they walk away with the t-shirt. They have the rewards of ownership, wearing the t-shirt. They have the risks of ownership, it's theirs. If they wash it wrong, if they don't follow my careful washing instructions, and it shrinks, that's on them. So transactions like that are fairly straightforward. Some, however, get a little bit trickier. What, for example, would you do with this? I'm a bank, and I decide to buy 68 tons of timber from a timber producer. But I have an option to sell that timber back to the bank in a year's time, and the seller has the option to buy it back in a year's time. Well, whatever happens to the price of timber, one of those options is going to be exercised, is going to come back. Transactions like that, well, that's really just a secured loan. It's not revenue. But in the past, companies have tried to sneak transactions like that through as sales. So that's why we needed a rule along these lines. My simple example there of a t-shirt, yeah, it's clearly a sale. When the bank is clearly holding on to timber for a year and then giving it back, that's a loan. And the underlying timber, the inventory, is being used as security. So it's all about risks and rewards. These days we have a converged US IFRS standard. They are almost identical. A couple of differences, as you can see there. But the converged standard has these 5 key points to decide whether we should recognize revenue. Number 1, we have to identify a contract with a customer. There has to be a contract in place. For that contract to exist, the standard says collectability on that contract, so getting cash from it or some sort of asset from it, has to be probable. So the two standards, or rather the two sets of standard makers, are agreed on this, that collectability has to be probable. But IFRS internationally, the wording for probable is more likely than not. US GAAP, the wording is likely to occur. Now that's not in this curriculum to say, you have to learn every single word of every single standard. That would be ludicrous. It's there to say, look, even when we have a converged standard where most of it is agreed upon, you still have to be careful as an analyst when there are differences between the two, because the exact same contract might be viewed differently by the two sets of standard setters. So just be a little bit careful. Number 2, you should identify separate, distinct performance obligations. This becomes interesting when you've got goods and services. So the classic example, the one the curriculum often runs through, you're selling software, you're going to install that software, but you're also going to provide support. So you've got the installation, you've got the provision of hardware, of software, and you've got the ongoing support. All of these could be separate performance obligations. Now remember, we're going to recognize revenue when it's earned, so be careful. We may be able to tick off the first obligation, maybe just the installation very quickly, but then maybe some more software comes in, then the support comes in, then the cloud services, and so on. Not necessarily the case that you earn all or nothing. You could do this in stages. 3, determine the transaction price. There should be a price we can identify for this contract, and we should be able to allocate that price to distinct obligations. How much for the installation, how much for the software, and so on. So we allocate the price to each of those obligations, and then, and I think you've probably seen this coming from our description, you recognize the revenue when the performance obligation is satisfied. But that's only if it is highly probable that the transaction will not be reversed. So we're not saying, look, have this software on a trial. So let's say it's a 28-day trial. See how you feel about it. And if you don't like it, send it back. No obligation. Everyone's happy. Well, that's not revenue. So if that happens, and let's say they've been paying you up front, so you have the cash for this trial, you must recognize that as a liability until you earn that revenue. They're the basic rules. Now, of those basic 5, number 5, recognizing revenue when an entity, as we said, satisfies a performance obligation, is the most interesting. So there is more guidance in the standard. Here it is. When have we satisfied a performance obligation? Well, when we've transferred control of the good or service to the customer. It's theirs. The entity has a present right to payment. So it's not like that trial where I said, look, it's yours. Don't need to pay me yet. There is a right to receive payment because they have taken the good or service. Customer has legal title. So we've not just transferred this inventory from our warehouse to theirs to make it look like a sale. That's been done a lot in the past. They've actually taken legal title. They have physical possession. It's not sat in our warehouse waiting to be sold. Now, sometimes that is a sale. We'll talk about it later. We said this up front. Customer has significant risks and rewards of ownership. And the customer has accepted the good or service. When Amazon or whoever it is turns up at your door delivering your goods, let's say they deliver a king-size bed in 83 pieces that you have to assemble, and stand there and present you that little screen where you have to put your signature in. You've accepted that good or service. Theoretically, you should open that box, check all 83 pieces to make sure they're there. You know for a fact there's going to be 82. Check all 83 pieces to make sure they're there. Otherwise, you shouldn't accept it, because if you have, well, they've satisfied their performance obligation. So these must all be met. These are all indications that revenue has been earned. And with that, we've covered every rule that the curriculum hits on revenue recognition. All that remains is to walk through some examples which kind of flesh this discussion out and give us a few more scenarios that we may meet in the exam. First one here is principal versus agent. Let's read through. Mega Digital is an online marketplace that sells goods and delivers them quickly to customers. I think we can all imagine real-world companies that do this. And for some sales, Mega Digital acts as a principal. What does this mean? Well, it controls the product before the goods are transferred to the customer. It's their product. They have it in their warehouse. They decide what to do with it. In other sales, Mega Digital acts as an agent, in which it transfers, or arranges rather, for the transfer of a product controlled by a third party. So they're sitting back and saying, look, there's a seller over there. You want to buy it? I'll just let the seller know you want to buy it. Off you go. In transactions in which Mega Digital is the principal, so this is the first situation, it is Mega Digital's inventory. Revenue is recorded as the total amount of considerations received for the transfer of the product. It makes sense. They have control of the product. It's theirs. They're selling it. In transactions in which Mega Digital is the agent, sits between these two parties. It records revenue only for the proportion, or rather for the portion of the considerations which amounts to its fee or commission. So if we're just an agent, all we're taking out as Mega Digital is a commission. Has a significant impact on common size and ratio analysis. Now, why does it say that specifically, common size and ratio analysis? Common size, something you've seen in the pre-reading. Well, the reason is the profit is likely to be the same. We're going to take out the same gain, but it'll give you a different revenue line and a different cost of sales line, which can have big implications for valuation models going forward, particularly based on revenue. Let's just see that in action. On the left, assume Mega Digital sells a particular product as a principal. We control the goods, they're ours, for $100 US. It's our goods. We are going to make a sale for $100. It's purchased for 70. So we bought it, got control of it for 70. There's my cost of sales. Gives me a gross profit of $30. There are $10 of other selling, general, and administrative costs, SG&A. So another 10 come off. Gives me net profit of 20. There's our figures. Here are our margins. Remember, margins are a percentage of sales. Pretty easy when sales are 100. 20% net profit, 30% gross. Compare that to the situation where we are simply an agent. And the first thing to do is start here at the bottom of this income statement. We're playing around with the exact same numbers, so we end up with the exact same net profit, 20. However, as we are only an agent, we take the commission of 30 as the sales figure. Our top line revenue figure is 30. We have no cost of sales. We didn't buy the goods for 70 and sell for 100. We just took a commission of 30. Gross profit is therefore still 30. We still had the extra 10 of SG&A to give a net profit of 20. We get down to the same net profit, but look at our ratio analysis. Now our net profit of 20, if we're only putting in revenue of 30, is 67% as opposed to 20. Gross profit is 100% as opposed to only 30. Moving on. Another example, long-term contracts. We have here Armored Vehicles Inc., AVI, manufactures weapon systems and vehicles for military customers. The company enters long-term contracts that generally extend over several years. So the issue here is going to be with that criteria 5, satisfying your performance obligations. Here, that performance is satisfied over time. Because it's several years, it's going to span accounting periods. Under IFRS 15, not too excited about learning the names and numbers of the standards, so don't worry about that. A performance obligation is satisfied over time if one of the following criteria is met. So the curriculum here is giving us extra information using these walkthrough examples, which is why they're important to go through. Firstly, the customer simultaneously receives and consumes the benefits provided by the entity's performance as the entity performs. In other words, as we are providing the service, they are consuming it. Service contracts, that's the example I gave earlier on. They are getting use out of that service contract as we're providing it. The entity's performance creates or enhances an asset that the customer controls as the asset is created or enhanced. As we do the work, they get to use it. Here, if we're refurbishing a factory owned and controlled by the customer, okay, they're getting the use out of it as we progress. Or finally, the entity's performance does not create an asset with alternative use to the entity, and the entity has an enforceable right to payment for the performance completed to date. We're building a big, what is this? It looks like a bespoke weapon system. Nobody else is going to be able to use it. And because I've committed to my resources, or rather committed my resources to building this, finishing this project, we have in the contract enforceable rights for payment. Once I'm 30% of the way through, you owe me this much. Once I'm 60% of the way through, you owe me this much, and it's enforceable. In that case, I can recognize revenue. So, specific numbers. As an example, contract to produce a weapon system for a total of 10 million. So there's our total revenue of 10 million. Expected total cost to produce the system, 7 million. So let's note this down. Total revenue is 10 million. Total costs are 7. So we're looking at a total profit, expected total profit of 3 million. It will take 2 years to produce. In year 1, AVI incurs 4.2 million of costs, representing 60% of the total estimated costs. So 4.2 in year 1. On a cost basis in year 1, that is 60%. AVI would recognize revenue of 6 million. Why? Well, on this basis, we're saying if we've completed 60% in year 1, let's take 60% of our total revenue. 6 million. 4.2 in costs. 1.8 million in profit. So, recognize revenue of 6 million, yep, and 1.8 million in profit in year 1. If in year 2 we complete it, okay, that seems pretty straightforward. Surely if we just complete it, well, let's add in the 4 of revenue. Let's add in the 2.8 of costs and off we go. But hang on. What actually happens is we end up with total cumulative costs of 7.5. We expected only 7. This isn't going to work. So what do? Revenue, that has not changed. So we're still going to put in 4 million of revenue. Company will report that 4 million, but costs, we'd only recorded 4.2. If in total we end up with 7.5, we have to add in 3.3 in year 2. That would give us a profit of 0.7 million. That's what goes on, not in year 8, in year 2. Cumulative profit, 1.8 and 0.7 together over the 2 years, that's 2.5, which makes sense because we had total revenue of 10 and total costs of 7.5. So a nice little practical example. The final example on revenue, bill and hold arrangements. We talked long-term contracts. Here, AVI comes back again from that example. They're producing now not weapon systems, but custom armored vehicles. So kind of the other side of the weapon system that some customers may not be able to take possession of immediately. For example, a lack of storage space. You just don't happen to have a spare room in your house for a large armored vehicle. IFRS 15 provides that in such, and it gives you the term for these, bill and hold arrangements. I mentioned this earlier when we said, look, I'll get a little bit dubious about whether I can recognize revenue if the customer hasn't taken physical possession. Well, here they haven't. They're not able to. This is a specific example called bill and hold. So AVI can determine when it satisfied its performance obligation based on when a customer obtains control of the product. That was another rule, another criteria we mentioned. Under IFRS 15, this is when all the following criteria are met. We're concerned because we said we'd like the customer to have physical ownership of the asset for us to recognize it. But IFRS 15 is accepting that's not possible in every case. So what you have to do is come to me and say, okay, I realize the customer doesn't have physical possession, but here's the reasons why. They're not able to. It's a bill and hold arrangement. And I'll say, as the standard writer, if you can prove all 4 of these to me, I'll overlook the fact that they don't have physical possession. Number 1, the reason for the bill and hold must be substantive. E.g., the customer has requested the arrangement. Many examples down the years of accounting manipulation where a company just pretended it was bill and hold. Put inventory in a separate room and said, oh, look, yeah, customers have bought this. They just haven't taken it yet. Well, where's the evidence that the customer asked you to do this? Product must be identified separately as belonging to the customer. So not, we've got 3,000 of these. About 1,000 will probably be purchased by people. That's not good enough. Must currently be ready for physical transfer to the customer. The only reason it's not there is because they don't want it, not because we haven't finished it or can't get it to them. The entity cannot have the ability to use the product or to direct it to another customer. Once again, we can't just say, look, there's 3,000 units here. I'm saying 1,000 of those are going to go to company ABC because they usually buy 1,000 around this time of year. Not good enough. If 1,000 of those are for ABC, we take them separately, store them in a separate part of the warehouse. We tag them as ABC's goods. They cannot be touched and they cannot be redirected. If it's possible they will be, it's not bill and hold. If all 4 of those are met, okay, it's bill and hold, and you might be able to recognize, or you will be if you meet them, be able to recognize revenue even though the customer doesn't have physical possession. In AVI's case, what goes on? Each vehicle is identified by a unique vehicle identification number, your VIN, and upon completion, title and risk of loss has passed to the customer. It's theirs. AVI recognizes revenue when the product is ready for delivery to the customer, but is directed by the customer. That was the key. That's a substantive reason to have it. They want us to keep it to hold delivery. So you can see the worry. It's a little bit early to recognize revenue, really, because they don't have it, but we've met these 4 criteria. It's their vehicle. They've got a unique VIN number, a unique identification number. We can't sell it to anybody else. Next up, it's expenses, moving down the income statement. Describe general principles of expense recognition, specific expense recognition applications, implications of expense recognition choices for financial analysis, and. So far it was very similar to revenue, just do everything we did for revenue, but and contrast costs that are capitalized versus those that are expensed in the period in which they are incurred. Let's get to it. Expenses. What do? Well, we recognize expenses in the period that economic benefits associated with the expenditure are consumed. So when we spend it, if we consume it, we recognize it. Or, and this is where it gets more fun, previously recognized economic benefit is lost. We can take those 2 rules and turn them into 3 separate models of recognizing expenses. First of all, matching. Matching says you must match expenses to revenues. The classic example here is inventory. You buy some goods for resale. If you haven't yet sold those goods, they just sit on your balance sheet as an asset. However, when you sell them and earn the revenue and recognize the sale, that inventory goes to the income statement in cost of goods sold. You're matching the expense to the revenue. Expensing as incurred, admin and payroll. The period costs. We got the benefit, we spent it, put them through this period. Finally, and this comes to our second point, capitalization and subsequent depreciation. So depreciation, tangible assets, or amortization, intangible assets. When we buy assets that are going to be long-lived, give us benefits over a period of time, they sit on the balance sheet. It's crazy if I buy a $15 billion asset, it's crazy to hit the income statement this year with $15 billion worth of expenses. Imagine releasing that set of accounts. Shareholders are going to say, what the hell? How have you managed to lose this money? And we'd have to say, well, we bought a $15 billion asset, which was a sensible move because that's going to generate revenues for us for the next 15 years. Okay, then, well, why don't you spread that $15 billion expense out over those 15 years when you earn revenues? That's a good idea. That's what we do. Now, just as for revenue, we've now gone through pretty much everything we need for expenses. There's not a lot to it, just the basics of the models. Best way to learn it now is to go through examples. So here's the first, inventory purchases. Remember we said for inventory, we were looking at matching. What happens with this company? It's KDL. We've got inventory purchases of 2,000, 1,500, 2,219, 76 total over the year in first, second, third, fourth quarter. We can see the prices are rising. This might be giving you an inventory reading feeling here. It gives us the total cost. KDL sold 5,600 units of inventory during the year. Let's just stop there for a moment. The matching rule says if I've sold 5,600 units of inventory during the year, 5,600 units need to go to cost of goods sold. Sales were at $50 per unit. Fine. Receive cash. KDL determines that there were 2,000 remaining units of inventory. Well, that makes sense. If I sold 5,600, I bought 7,600 in total. All they're saying there is we haven't lost any. They're all sat in the warehouse. And specifically identifies that 1,900 were those purchased in the fourth quarter. 100 were purchased in the third. What are the revenues and expenses associated with these transactions during the year based on specific identification of inventory items as sold or remaining? So if you have looked at the inventory reading, they don't want us to get into LIFO and FIFO here. They're telling us literally which units are left. 1,900 from the fourth, 100 from the third. So it should be pretty straightforward. What's the solution? Revenue, 280,000, 5,600 units at 50 per unit. Doesn't matter what the costs were. The fact is every single one was sold at 50. There's our revenue. Total cost of goods purchased all goes into inventory. We can see the calculation for the first, second, third for COGS. That adds up to 231,800. We can see what's left in inventory. That adds up to 89,800. Those two together represent the total cost of the inventory we purchased. So our initial move was to put all of that onto the balance sheet as an asset. But we sold 5,600 and we will match. That was our first rule. Match 5,600 units of cost against those 5,600 units that were sold. The 2,000 stay on the balance sheet. We know which ones are on the balance sheet. 1,900 from the fourth, 100 from the third, 19 and 100. 89.8 is on the balance sheet in inventory. The rest, and you can see, and by all means check the math if you want to, 231,800 will go through the income statement. That's my expense that I've matched to my 282 revenue. Next up, an example of capitalizing versus expensing. There were 3 expense models. The middle one, charge the expense as we get the benefit, not really interesting. So you pay admin expenses and you expense them. Let's instead focus on the third one, capitalizing and expensing, and that was mentioned separately in the LOS as well. What do we have? 2 companies, Cap and Now. What are we told? 2 identical hypothetical companies, Cap Inc. You can probably guess what Cap Inc. are going to do here. And Now Inc. start with €1,000 in cash, €1,000 common stock. Each year, the companies recognize total revenues of €1,500 in cash, make cash expenditures, excluding an equipment purchase of €500. So that's identical between the 2 as well, excluding the equipment purchase. At the beginning of operations, each company pays €900 to purchase equipment. This is where we're going to get a difference. So let's track what happens with Cap. Cap estimates the equipment will have a useful life of 3 years. So cost of 900 for the asset, because they're saying it's got a UEL of 3 years, and an estimated salvage value of 0. So the salvage is nothing. Now estimates a much shorter useful life and expenses the equipment immediately. So Now just says, look, this quite simply is another cash expense of 900. There is no asset. The companies have no other assets, make no other asset purchases during the 3-year period. The companies pay no dividends, earn 0 interest on cash balances, and have a tax rate of 30%, and use the same accounting method for financial and tax purposes. What does that mean? They're using the same method. There are no deferred taxes to worry about. That just keeps the example simple. Let's see the impact on the accounts. What does cap look like first of all? We have an asset that costs 900, lasting 3 years with no salvage value. Depreciation expense each year, let's assume straight line, will therefore be 300. You know from your pre-reads, cost less salvage over useful economic life. What does that translate to? Let's start with the income statement. Revenue is the 1,500 of cash. That's pretty straightforward. Cash expenses. We had cash expenses here of 500, excluding the capital equipment purchase. 500. We are not including the 900 as a cash expense because we said it was an asset. We're spending money on an asset that doesn't go to the income statement. Instead, we're charging depreciation in years 1, 2, and 3 of 300. So you can see the depreciation each year. That leaves us in year 1, income before tax of 700. Tax authorities, they're using this exact same income before tax figure because they're using the same depreciation. Remember, no differences here. They'll tax us 30% of 700, that's 210. Net income is 490. What about the cash flow statement? Cash from operations, let's just go through the income statement and find every cash flow. 1,500 is cash, less 500 cash expenses, that's 1,000. Depreciation is non-cash. Won't deduct that. So still got 1,000 less the 210 I pay in tax. That leaves me with CFO of 790. Other way to do it is to start with net income and add back your 300 depreciation. Either way, it's 790. Cash used in investing. CFI. Remember, CFO is your operation. CFI is investing. If we purchase an asset, the 900 we spend on the asset is an outflow in CFI. 790 less 900. Change in cash, negative 110. Into year 2. Same revenue, same cash expenses, same depreciation. Income is 700, same tax, net income 490. Cash flow statement, we still have the CFO of 790. No outflow in CFI. Didn't buy any more assets, so this time plus 790, and year 3 will look remarkably similar. Same revenue and cash expenses, depreciation, same tax, and identical to year 2. No asset purchases, so 790, change in cash. How does that differ for now? This is where it's fun. Revenue is the same cash revenue. Expenses, though, because now expense the 900, all 900 is being charged to the income statement right away. So they have a huge hit of 1,400 in year 1. No depreciation any year because there's no asset. Income before tax, 15 less 14 is only 100. Tax authorities use the same treatment. So they tax at 30%. There's 30. Net income, 70. Clearly a lot lower. Why? The answer should be obvious. The entire 900 has gone through as a cash expense. Cash flows? Well, there are no non-cash flows in the income statement, so cash from operations, CFO, is 70. CFI isn't going to get touched. No asset to treat, no asset purchased, no CFI. Change in cash is 70. So you can see a couple of implications. First of all, the obvious one, net income is lower because the entire expense went through this year. Secondly, in year 1 for now, we saw an increase in cash of 70. Cash went from 1,000, if you check the balance sheet, to 1,070. For cap, cash dropped. That's because of the difference in the tax charge. In year 1, 210 because we made that 700 profit, only 30 because we only made 100. There's your difference of 180 in the tax charge, minus 110 to plus 70. In year 2, what happens for now? 1,500, less cash expenses now, only 500 and no depreciation. Profit is now 1,000. Profit is higher in year 2. Tax is also a little bit higher, 300, but we still end up with 700 of net income. That is higher. Why? No depreciation. Cash flows, again, no non-cash, so it's 700, no CFI, 700. We get a boost to cash of 700, takes us up to 1770. What happened to cap? 790 CFO, no CFI, a boost to cash of 790, takes us on the balance sheet up to 1680. Why the difference? Again, it's the tax treatment. In year 2, cap charged 300 of depreciation, brought their income before tax down to 700 instead of 1,000, paid less tax. Only 210 instead of 300. That is the difference of 90 you see between the tax, difference of 90 in the cash flows. And exactly the same thing happens in year 3. A difference of 90 again due to that depreciation. But look what happens overall. When the 790 gets added by the end of year 3 to cap, the 700 gets added by the end of year 3 to now, your cash position at the end of the year 3 is identical. Why? Because we've spent the same amount and been taxed the same amount. We got tax relief for 300 over 3 years or tax relief for 900 in 1 year, and we both spent 900. Therefore, by the end of year 3, your position is identical, I should say. However, how we get there is different. We've already tracked the difference in the cash position. Looking at our PPE, by the end of year 1, a $900 asset for cap, depreciated by 300, it's 600. Depreciate another 3, it goes down to 3, depreciate, it's gone. It's identical by the end of year 3 for now because they never capitalized it, but it's different year to year. That gives you a different figure for total assets. Cash is different, PPE is different, total assets looks different. So end of year 1, 1490 for cap, 1070 for now. Difference in both your cash and your PPE. Still different at the end of year 2, 1770 for now, 1980 for cap. Once again, by the end of year 3, we are in the exact same position. You have to be. The asset has been depreciated to 0 in both cases by the end of year 3, and the cash spent was the same. Retained earnings. Story should hopefully be getting familiar by now. It's different as we tick along due to the different net income figures, but by the end of year 3, we have the same total retained earnings. Didn't touch common stock, so that's not too exciting. Total shareholders' equity builds up in a different way, but gets back to the same figure at the end of year 3. Now, I know that's a long example to go through, but it's a great example. I encourage you to work through it again. A great example of how two companies doing the exact same thing, but capitalizing versus expensing, end up with fundamentally different looking sets of accounts. Now what you could do as an analyst is go to town on your ratios. Look what's different. Let's just take the end of year 1. 1490 total equity, 1490 total assets, as opposed to now 1070, 1070. Any ratio you now calculate that uses total assets, return on total assets, for example, financial leverage includes total assets, is going to be different because your total assets figure is different, despite the fact that companies have done nothing different except treat that 900 differently in terms of capitalizing and expensing. Now, that last example was a little bit of a marathon. This one's going to be quicker, but it touches on the same point, more capitalizing and expensing. But I think more realistic this time, brings out a good point. Start on the left. A company buys a £300 computer in year 1, that's the currency, not the weight, and capitalizes the expenditure. Computer has a useful life of 3 years and expected salvage value is 0, so annual depreciation expense using straight line method, 100 per year, makes sense. Compared with expensing at the entire 300 immediately, The company's pre-tax profit in year 1 is £200 greater. I agree, that's fairly straightforward. So year 1, having capitalized it, we're just charging $100 of depreciation expense. If you expense it, the whole $300. You can see there's a difference of $200. That makes sense. Number 1, assume the company continues to buy an identical computer each year at the same price, $300. If the company uses the same accounting treatment for each of the computers, same accounting treatment means $300 cost, useful life of 3 years, salvage value 0, depreciation 100. When does the profit enhancing effect of capitalizing versus expensing end? Well, let's roll this forward and see what happens in year 2. In year 2, we're still depreciating that first computer we bought. It's over 3 years. But we also buy a second one. So we'll start depreciating that one. We expense the second computer that we bought in year 2, so there's expense of $300. So in year 2, we have a total depreciation expense of $200 on our 2 assets. Should say in year 1 it was $100, $300 in year 1, $300 in year 2. We still have a profit enhancing effect. 2 computers at $100 each, only $200, as opposed to $300 expensing it. But look at year 3. We continue to buy computers, so $100 in year 3 on the first computer, $100 a depreciation expense on the second one. We buy a third computer, and we'll charge $100 on that. Total depreciation expense is now $300. That matches the $300 we'll charge for writing off the third computer. No profit enhancing effect in year 3. It ends. Now, you might be thinking what happens after that. You might not, but let's just have a look anyway. In year 4, well, we've fully depreciated the first computer. That's gone. Second one still gets charged $100. Third one gets charged $100. And we buy another one. Remember, we keep buying them. So that's going to be $300 again. And if we expensed, we'd write off that entire $300. So year 3 and year 4 onwards, no enhancing effect. Number 2, if the company buys another identical computer in year 4 using the same accounting treatment as the prior years, what is the effect on year 4 profits of capitalizing versus expensing those expenditures? There is no impact in year 4. As we just saw, the first computer has dropped out. Next up in our expenses journey, interest. This one you might think, well, surely this is easy. Interest is an expense, it goes to the income statement. Not necessarily. The issue we have is that companies must capitalize interest costs. What does that mean? Take them to the balance sheet. Associated with acquiring or constructing an asset that takes a long period, so this is going to stretch over accounting periods, long period of time to get ready for its intended use. Remember from the pre-reads, the basic rule is that any cost of getting an asset ready for its intended use must be included in the cost on the balance sheet. If you have interest costs associated with building an asset, they must get onto the balance sheet as part of the cost of the asset. So that means if you're building an asset for your own use, these interest costs get capitalized as part of the cost of the long-lived asset on the balance sheet. If it's something you're going to sell, still on the balance sheet, but as part of inventory. Now, does that mean the interest cost never hits the income statement? No. It will get there, but it will go through the income statement as depreciation. You will never see it in the income statement as interest as an analyst. Where will it be in the cash flow statement? Again, it is there, but because you are capitalizing, it's an investing flow, it's CFI. If it was an asset to sell, it will get through the income statement, but it will get through the income statement when the inventory does, i.e. as cost of sales when it's sold. When you are building the inventory, putting it on the balance sheet, capitalizing, it's an investing flow. That's the issue. Interest costs are of great interest, no pun intended, to the analyst, when we are looking at whether or not we can repay our debts. And a big ratio to consider in this context is interest coverage. Lots of ways of calculating it, but imagine you did it this way. EBIT, our earnings before interest and tax. How much earnings do we have available to cover our interest expense? Now, I'm not saying you would do it this way. Maybe you're jumping all over this and saying, well, hang on, Richie, why don't we just go and find interest paid? Well, that's going to be a good solution. That's what the curriculum would suggest. But it does point out the problem with using the income statement. If you use interest expense, you're missing out on interest that has been capitalized. There is some interest that's gone into long-lived assets and maybe inventory that isn't included. That doesn't include any interest that's been capitalized. But the problems don't end there. If you're just thinking, okay, well, I'll just take interest paid and I'm good. We also have a problem with EBIT. Because earnings before interest and tax will include interest elements of depreciation and COGS. The interest portion of depreciation and COGS will have been deducted from EBIT. We don't want that included. We can't double count this. We can't say, well, I want to put that interest as interest paid on the bottom in the denominator and also have EBIT reduced. If we're going to strip it out, it needs to be stripped out of the numerator and the denominator. Let's take a look at an example. Here we have Melco Resorts. We have some not too interesting information about where it's from. It's a casino company. It's on NASDAQ. It's US GAAP. All we're interested in are these disclosures starting here. Interest and amortization of deferred financing costs associated with major development and construction projects is capitalized and included in the cost of the project. We have the figures. They're listed out here in not completely user-friendly manner, but we've got it down here in a nice table. Total interest expenses incurred amounted to, 267, 252, 253, of which, here we go, 37,483, 29,033, and 134,838 were capitalized during the 3 years that we're looking at. So here is our capitalized interest. Continuing, amortization of deferred financing costs 26,182, 48,345, and 38,511. Again, here we have it in a nice user-friendly way. Net of amortization of capitalized of 0,0 and 5,458, so other things that we don't need to worry about, were recorded during the years 17, 16, and 15. So these are the balances that we're interested in.